Question 1. Scenario-based question. Mr. Anderson is a Delaware-based insurance producer who has recently entered into a contract with the client, Mr. Wilson, for a new life insurance policy. The client has disclosed a pre-existing condition of diabetes, but Mr. Anderson believes that the condition will not impact the issuance of the policy. The client is not aware that the policy contains an exclusion related to pre-existing conditions, and after issuing the policy, Mr. Wilson is diagnosed with complications from his diabetes and attempts to file a claim. Which of the following actions should Mr. Anderson take in this situation? A. Apologize to Mr. Wilson for any confusion and assist him in filing a claim under the policy even though the pre-existing condition is excluded. B. Immediately notify Mr. Wilson of the pre-existing condition exclusion and provide guidance on the claims process ensuring transparency. C. Tell Mr. Wilson that the policy is not valid and advise him to find a new insurer without offering any additional assistance. D. Ignore the situation as the insurer will handle the claim and Mr. Anderson does not need to inform the client about the exclusion. Answer. B. Immediately notify Mr. Wilson of the pre-existing condition exclusion and provide guidance on the claims process ensuring transparency. Explanation. As an insurance producer in Delaware, Mr. Anderson has an ethical obligation to act in the best interest of the client and provide full disclosure of any relevant policy terms, including exclusions. Delaware Insurance Code. It is essential that he communicates clearly with Mr. Wilson about the pre-existing condition exclusion and offers assistance in navigating the claims process. Failing to disclose such terms could lead to misrepresentation and may result in legal consequences for Mr. Anderson. Delaware insurance laws and regulations. Ensuring transparency and ethical conduct is crucial in avoiding unethical practices like misrepresentation and aiding in consumer protection. Question 2. Multiple choice question. Which of the following is true regarding the role of the Delaware Department of Insurance (DOI) in regulating insurance producers? A. The DOI is solely responsible for setting insurance rates and deciding which insurance products are allowed to be sold in the state. B. The DOI issues licenses to insurance producers but does not have authority over the actions or conduct of producers once they are licensed. C. The DOI is tasked with enforcing the state's insurance laws, ensuring that producers comply with regulatory requirements and protecting consumers from unethical practices. D. The DOI has no regulatory role and only facilitates the creation of insurance policies through private industry. Answer. C. The DOI is tasked with enforcing the state's insurance laws, ensuring that producers comply with regulatory requirements and protecting consumers from unethical practices. Explanation. The Delaware Department of Insurance (DOI) has a critical role in regulating the state's insurance industry. This includes issuing licenses to insurance producers, ensuring that producers adhere to legal and ethical standards, and investigating any violations. The DOI is tasked with enforcing Delaware's insurance laws, including overseeing producers' conduct, licensing requirements, continuing education, and ethical responsibilities as outlined in the Delaware Insurance Code and related regulations. This ensures consumer protection and fairness in the marketplace. Delaware insurance laws and regulations. The DOI's role goes beyond just setting rates. It involves oversight, compliance, and regulation of producers. Question 3. Multiple choice question. Which of the following best describes the concept of insurable interest in the context of property and casualty insurance? A. Insurable interest is the value of the property being insured, which must be equal to the amount of coverage provided by the policy. B. Insurable interest refers to the financial interest a person has in the continued existence of the property or life being insured, ensuring they would suffer financial loss if the property or individual were harmed or lost. C. Insurable interest means that only the policyholder and not anyone else can benefit from the policy proceeds, regardless of their relationship to the insured property or person. D. Insurable interest is the requirement for the insured to prove that they own the property being insured, but does not apply to life insurance. Answer. B. Insurable interest refers to the financial interest a person has in the continued existence of the property or life being insured, ensuring they would suffer financial loss if the property or individual were harmed or lost. Explanation. Insurable interest is a fundamental principle in insurance, requiring the policyholder to have a legitimate financial interest in the property or person being insured. In property and casualty insurance, the policyholder must show that they would suffer a financial loss if the insured property were damaged, destroyed, or lost. Delaware Insurance Code. This principle ensures that insurance serves as a tool for risk management rather than as a form of gambling. For life insurance, insurable interest must exist at the time the policy is issued, but it is not required for the policy's entire duration. Without insurable interest, an insurance contract would be considered void. Insurance fundamentals. Question 4. Multiple choice question. Which of the following best explains the concept of subrogation in an insurance contract? A. Subrogation allows the insurer to settle a claim directly with the insured, bypassing the responsible third party. B. Subrogation enables the insurer to recover the amount of a claim paid to the insured from the party responsible for the loss. C. Subrogation prevents the insurer from seeking reimbursement from third parties once a claim is settled. D. Subrogation is a provision that allows the insured to recover damages from the insurer if the insurer refuses to pay a claim. Answer. B. Subrogation enables the insurer to recover the amount of a claim paid to the insured from the party responsible for the loss. Explanation. Subrogation is the process by which an insurance company seeks reimbursement from the responsible third party after paying a claim to the insured. This practice helps prevent the insured from being overcompensated and ensures that the party responsible for the loss ultimately bears the financial burden. The insurer steps into the shoes of the insured and has the right to pursue the responsible party for the amount of the claim paid out. Principles of insurance. This process protects both the insurer and the insured and is fundamental to the insurance concept of indemnity. Question 5. Scenario-based question. Ms. Taylor is a Delaware insurance producer who recently recommended a health insurance policy to her client, Mr. Harris, after conducting a thorough needs analysis. Upon reviewing the policy details, Mr. Harris expresses concerns about the premium cost and asks if any discounts are available. Ms. Taylor suggests a discount that she believes will apply, but she has not verified it with the insurance company. Which of the following is the best course of action for Ms. Taylor? Ms. Taylor should tell Mr. Harris that the discount will be applied and move forward with the sale, trusting that the discount will be honored. BMS. Taylor should inform Mr. Harris that she is unsure about the discount and will need to confirm it with the insurance company before proceeding. CMS. Taylor should proceed with the sale and offer a discount that she believes will apply without informing Mr. Harris that it has not been confirmed. DMS. Taylor should refuse to discuss the discount further and advise Mr. Harris to shop around for other policies. Answer. BMS. Taylor should inform Mr. Harris that she is unsure about the discount and will need to confirm it with the insurance company before proceeding. Explanation. Ethically, insurance producers must provide full and accurate information to their clients. In this situation, Ms. Taylor should not offer a discount unless she has verified it with the insurer. Misrepresentation, even unintentionally, could lead to legal consequences for the producer and could potentially harm the client. Ethical responsibilities and legal obligations. Transparency and honesty are key principles in insurance sales, and Ms. Taylor must prioritize confirming the discount with the insurer before making any promises to the client. Question 6. Multiple choice question. Which of the following is not a responsibility of an insurance producer when handling client funds? A. The insurance producer must keep all client funds in a separate account from their personal funds, ensuring proper accounting and protection. B. The insurance producer can use client funds for their own personal expenses as long as they repay them later. C. The insurance producer must promptly forward client premiums to the insurer to ensure timely policy issuance. D. The insurance producer must ensure that they do not misappropriate or misuse client funds for any unauthorized purposes. Answer. B. The insurance producer can use client funds for their own personal expenses as long as they repay them later. Explanation. Insurance producers have a fiduciary duty to handle client funds with the utmost care and integrity. They must never use client funds for personal expenses, even if they intend to repay them. Doing so would be a violation of ethical and legal standards. Fiduciary duty and ethical responsibilities. All client funds must be kept separate from personal accounts and managed transparently to protect the interests of the client and maintain trust in the insurance industry. Delaware insurance laws and regulations. Misuse of client funds can lead to severe legal consequences, including license revocation. Question 7. Multiple choice question. Which of the following provisions in a life insurance policy ensures that the policy will not be voided if the insured dies by suicide within a certain period after the policy is issued? A. The contestability clause. B. The incontestability clause. C. The suicide clause. D. The grace period clause. Answer. C. The suicide clause. Explanation. The suicide clause in a life insurance policy typically specifies that If the insured dies by suicide within a set period, usually 2 years after the policy is issued, the insurer will not pay the death benefit. Instead, the insurer may refund the premiums paid to the beneficiary. This clause is designed to prevent individuals from purchasing life insurance with the intent of committing suicide shortly thereafter to provide a death benefit to their beneficiaries. Policy provisions. It is distinct from the contestability clause, which allows the insurer to investigate the validity of a claim within the first 2 years. Question 8. Multiple choice question. Which of the following would not be considered an unfair claims practice under Delaware law? A. Denying a claim without conducting a reasonable investigation. B. Failing to acknowledge and respond to claims within a reasonable period. C. Offering to settle a claim for less than the policy limits based on the insurer's discretion. D. Attempting to settle claim for lower amount than what the insured is entitled to under the policy. Answer. C. Offering to settle a claim for less than the policy limits based on the insurer's discretion. Explanation. Delaware law prohibits several unfair claims practices, including denying claims without reasonable investigation, failing to acknowledge claims in timely manner, and offering settlements below what the insured is entitled to under the terms of the policy. Unfair claims practices, however, offering to settle claim for less than the policy limits, if done transparently and with the consent of the insured, is not necessarily considered unfair. It becomes unfair when the insurer intentionally undervalues the claim or pressures the insured into accepting lower settlement amount without valid reason. Unfair Trade Practices Act. Question 9. Multiple choice question. Which of the following best describes the principle of indemnity in insurance? A. Indemnity guarantees a profit for the insured in the event of a loss. B. Indemnity ensures that the insured receives the full amount of their premium back after a loss. C. Indemnity provides a payout to the insured that is equal to their financial loss, but no more. D. Indemnity allows the insured to recover both financial and emotional damages after a loss. Answer. C. Indemnity provides a payout to the insured that is equal to their financial loss, but no more. Explanation. The principle of indemnity ensures that the insured is compensated only to the extent of their financial loss and does not make a profit from an insurance claim. This principle prevents overcompensation and protects the insurer from excessive payouts. It is a core tenet of insurance contracts and maintains fairness by ensuring that the insured is restored to the same financial position they were in before the loss without being enriched. Principles of insurance. Question 10. Multiple choice question. Which of the following best defines insurable interest? A. Insurable interest refers to a person's financial stake in the safety of property or life, which justifies the purchase of insurance on it. B. Insurable interest means the policyholder has the right to change the beneficiary of life insurance policy. C. Insurable interest is the expectation of receiving an insurance payout in the event of loss. D. Insurable interest occurs when person insures property that they do not own but have permission to insure. Answer A. Insurable interest refers to a person's financial stake in the safety of property or life, which justifies the purchase of insurance on it. Explanation. Insurable interest is a critical requirement for purchasing insurance. It means that the policyholder must have legitimate financial interest in the insured property or person, such that loss would cause them financial harm. This principle prevents people from purchasing insurance on property or lives in which they have no stake, thereby reducing moral hazard and ensuring that insurance remains a tool for financial protection, not speculation. Insurance fundamentals. Question 11. Scenario-based question. Mr. Green, a Delaware resident, recently purchased a homeowner's insurance policy through his agent, M.S. Roberts. After a fire damages his home, Mr. Green files a claim with the insurer. During the claims process, it is discovered that Mr. Green failed to disclose that he had recently made significant structural changes to his home without notifying the insurer. What is the most likely outcome in this scenario? A. The insurer will pay the claim in full as long as Mr. Green can provide a reasonable explanation for the failure to disclose. B. The insurer will deny the claim based on the misrepresentation of facts during the underwriting process. C. The insurer will offer a partial settlement covering only the damages that were not related to the recent structural changes. D. The insurer will cancel the policy immediately and refuse to provide any claim settlement. Answer. B. The insurer will deny the claim based on the misrepresentation of facts during the underwriting process. Explanation. Failing to disclose material information such as recent structural changes that may affect the risk of loss is considered misrepresentation or non-disclosure. This misrepresentation can lead to the denial of the claim as it impacts the insurer's ability to properly assess risk. Delaware insurance laws and regulations. An insurer may void a policy or deny a claim if it is found that the insured provided false or incomplete information during the underwriting process, as this violates the principle of utmost good faith insurance contract basics. Question 12. Multiple choice question. Which of the following is not a provision typically found in a health insurance policy? A. Deductibles. B. Copayments. C. Inflation protection. D. Coinsurance. Answer. C. Inflation protection. Explanation. Health insurance policies typically include provisions like deductibles, copayments, and coinsurance, which describe how much the insured must pay out of pocket for certain services. Inflation protection is not typically a provision found in health insurance, as it is more commonly associated with life or property insurance policies. Health insurance is generally designed to cover medical expenses and related costs, with specific provisions related to the sharing of these costs between the insurer and the insured. Health insurance provisions. Question 13. Multiple choice question. Which of the following would most likely be considered an unfair trade practice under Delaware law? A. Failing to clearly explain policy exclusions to a client before the sale. B. Recommending a policy that does not meet the needs of the client but offers the producer the highest commission. C. Disclosing the insurer's financial rating to the client. D. Offering discounts for bundled policies provided that the discounts are available to all clients. Answer. B. Recommending a policy that does not meet the needs of the client but offers the producer the highest commission. Explanation. Recommending a policy that does not suit the client's needs is considered unethical and an unfair trade practice. Producers are required by law to recommend policies that are suitable for the client, ensuring the client's best interests are served. To ethical sales practices. Offering policy purely for the purpose of receiving higher commission, regardless of its appropriateness for the client, violates ethical and legal standards as it creates conflict of interest. Question 14. Multiple choice question. Which of the following is a key characteristic of a claims-made liability policy? A. Coverage is only available for incidents that occur during the policy term, regardless of when the claim is filed. B. Coverage is provided for incidents that occur and are reported during the policy term. C. Coverage applies to all claims made during the policy period, regardless of when the incident occurred. D. Coverage is available for claims made during the policy term as long as the incident occurred within the past 10 years. Answer. B. Coverage is provided for incidents that occur and are reported during the policy term. Explanation. A claims-made policy provides coverage only if the claim is made during the policy term, regardless of when the incident occurred. This differs from an occurrence policy, which covers claims based on when the incident occurs, regardless of when the claim is filed. Claims-made policies typically require retroactive coverage or an extended reporting period, tail coverage, to cover claims made after the policy expires. Liability insurance. Question 15. Multiple choice question. Which of the following is not a typical requirement for an insurance producer to maintain their license in Delaware? A. Completing continuing education requirements. B. Paying annual licensing fees to the Delaware Department of Insurance. C. Maintaining a minimum number of active clients. D. Passing a background check. Answer. C. Maintaining a minimum number of active clients. Explanation. To maintain their license in Delaware, insurance producers are required to complete continuing education, pay licensing fees, and undergo background checks. However, there is no requirement for producers to maintain a minimum number of active clients. The focus is on professional competence, ethical conduct, and legal compliance. Delaware insurance regulations. Question 16. Multiple choice question. Under the Delaware Unfair Trade Practices Act, which of the following is considered a prohibited practice? A. Offering a client information on several insurance options. B. Denying a claim based on an ambiguous policy exclusion. C. Offering discounts to clients who purchase multiple types of insurance. D. Disclosing information about a client's claim to unauthorized parties. Answer. D. Disclosing information about a client's claim to unauthorized parties. Explanation. Disclosing clients' claim information to unauthorized parties violates confidentiality provisions and is considered an unfair trade practice under Delaware law, confidentiality, and privacy laws. This practice breaches the trust that clients place in their insurance producers and can lead to legal penalties. Other practices, such as offering discounts or informing clients of multiple options, are not prohibited as long as they are conducted ethically and within the legal framework. Consumer Protection and Unfair Trade Practices Act. Question 17. Scenario-based question. Mr. Scott is a Delaware insurance producer who receives a significant commission for selling life insurance policies. He is aware that one of his clients, Ms. Williams, is unlikely to qualify for a policy due to her medical history. Mr. Scott, however, pressures Ms. Williams into applying for the policy, assuring her that she will qualify. Which of the following actions would be the most appropriate for Ms. Williams after realizing the situation? A. She should continue the application process and attempt to qualify for the policy to satisfy Mr. Scott. B. She should file a complaint with the Delaware Department of Insurance regarding Mr. Scott's unethical behavior. C. She should cancel the application and attempt to find policy from different producer. D. She should accept the policy even if she does not meet the requirements, as it is her decision. Answer. B. She should file a complaint with the Delaware Department of Insurance regarding Mr. Scott's unethical behavior. Explanation. Mr. Scott's actions, pressuring Ms. Williams into applying for policy she is unlikely to qualify for, constitutes unethical conduct and possibly misrepresentation. Ms. Williams should file complaint with the Delaware Department of Insurance. Delaware insurance laws and regulations, as producers must act in the best interests of their clients and provide honest, transparent advice. This behavior is in violation of ethical and legal standards. Ethical responsibilities. Question 18. Multiple choice question. Which of the following is a key feature of an umbrella insurance policy? A. It provides additional coverage for incidents not covered by other primary policies, such as auto or homeowners insurance. B. It covers all risks, including those excluded from the primary insurance policies. C. It only covers liability claims above the limits of the underlying policies. D. It provides coverage for damages to the insured's property only. Answer A. It provides additional coverage for incidents not covered by other primary policies, such as auto or homeowners insurance. Explanation. Umbrella insurance is designed to provide additional coverage beyond the limits of a policyholder's primary insurance, such as auto or homeowners insurance. It typically covers a broader range of risks, including those that may not be covered by the primary policy, like slander, libel, or certain types of accidents that occur outside the home. Umbrella insurance does not cover all risks but extends the protection of existing policies, liability insurance, and risk management. Question 19. Multiple choice question. What is the primary purpose of reinsurance in the insurance industry? A. To provide insurance to policyholders who cannot obtain coverage from primary insurers. B. To transfer a portion of the risk from one insurer to another in exchange for a premium. C. To insure against natural disasters such as hurricanes and earthquakes. D. To cover operational costs and administrative expenses of an insurance company. Answer. B. To transfer a portion of the risk from one insurer to another in exchange for a premium. Explanation. Reinsurance allows insurance companies to transfer some of their risks to other insurers, typically in exchange for a premium. This helps primary insurers manage their risk exposure, particularly in cases of large claims or catastrophic events, and ensures that they can continue to provide coverage to their policyholders. Reinsurance does not directly involve providing coverage to individuals, but helps stabilize the insurance market as a whole. Reinsurance principles. Question 20. Multiple choice question. In Delaware, what is the maximum time period within which an insurance company must provide a written acknowledgement of a claim after receiving it? A. 10 days. B. 15 days. C. 30 days. D. 60 days. Answer. B. 15 days. Explanation. Under Delaware law, insurance companies must acknowledge the receipt of a claim in writing within 15 days of receiving the claim. This prompt acknowledgement helps ensure transparency and communication between the insurer and the insured. Failure to do so can result in penalties or fines for the insurance company. Delaware insurance laws and claims handling. Question 21. Multiple choice question. Which of the following best describes moral hazard in insurance? A. The risk that an insurance policyholder may engage in risky behavior knowing that they are covered by insurance. B. The risk that an insurer will not pay a claim due to financial instability. C. The risk that a policyholder will intentionally damage their property to collect insurance benefits. D. The risk that an insurance company will overestimate the value of a property being insured. Answer A. The risk that an insurance policyholder may engage in risky behavior known that they are covered by insurance. Explanation. Moral hazard refers to the increased risk that an individual may take on more risk because they know they are insured. This can lead to reckless behavior or a lack of caution, as the insured party does not bear the full consequences of their actions. Insurers try to mitigate moral hazard by applying deductibles, copays, and other measures to reduce the likelihood of excessive claims, risk management, and behavioral economics. Question 22. Scenario-based question. A car insurance policyholder in Delaware was involved in an accident and the vehicle was considered a total loss. The insurer, after assessing the damage, offered the policyholder the actual cash value (SCV) of the vehicle. The policyholder disputes the amount, claiming it is too low compared to the market value of similar cars. What should the policyholder do next? A. Accept the insurer's offer as the SCV is the maximum they are entitled to under the policy. B. Request a second opinion or an independent appraisal to verify the vehicle's market value. C. Immediately file lawsuit against the insurance company for the difference in value. D. Contact the Delaware Department of Insurance to report the insurer for libel. Answer. B. Request a second opinion or an independent appraisal to verify the vehicle's market value. Explanation. If policyholder disagrees with the insurer's valuation of their car under an SCV policy, they have the right to seek second opinion or an independent appraisal to support their claim. This allows the insured to provide evidence of the car's market value, potentially leading to higher payout. Filing lawsuit or contacting the Department of Insurance might be premature unless all reasonable attempts at resolving the issue have failed. Claims dispute and consumer rights. Question 23. Multiple choice question. Which of the following is a type of policy that covers an insured's legal liability for bodily injury or property damage to others? A. Health insurance. B. Life insurance. C. Liability insurance. D. Property insurance. Answer. C. Liability insurance. Explanation. Liability insurance is designed to protect an individual or business from legal liability for bodily injury or property damage caused to others. It provides coverage for legal defense costs and any settlements or awards resulting from a claim or lawsuit. This type of insurance is essential for anyone who could potentially be held responsible for damages to another person or their property. Liability coverage and risk management. Question 24. Multiple choice question. In a typical auto insurance policy, which of the following would be considered an example of comprehensive coverage? A. Damages resulting from a collision with another vehicle. B. Injuries sustained by the driver in an accident. C. Damage caused by a hailstorm to the vehicle. D. Property damage caused by the insured to someone else's vehicle. Answer. C. Damage caused by a hailstorm to the vehicle. Explanation. Comprehensive coverage in an auto insurance policy typically covers damage to the vehicle caused by events other than a collision, such as natural disasters, e.g. hailstorms, vandalism, theft, or hitting an animal. It does not cover damages resulting from a collision, which would be covered under collision coverage, or injuries to the driver, which would be covered under personal injury protection, auto insurance, and coverage types. Question 25. Scenario-based question. After receiving a payment from her homeowner's insurance policy for fire loss, Mrs. Davidson realizes that her claim payout did not cover all of the rebuilding costs. She believes the settlement was lower than what was owed. What is the first step Mrs. Davidson should take? A. Appeal the settlement directly with the insurance company's claims department. B. File complaint with the Delaware Department of Insurance. C. Hire a lawyer to sue the insurance company for the difference. D. Accept the payment as is, assuming the insurer has more experience than she does. Answer. A. Appeal the settlement directly with the insurance company's claims department. Explanation. The first step in resolving dispute over claim payout is to directly communicate with the insurer and request review of the settlement. Often misunderstandings or errors can be addressed through this process. If the issue is not resolved, then the policyholder can escalate the matter by filing complaint with the Department of Insurance or seeking legal advice. Filing lawsuit should be considered only after all other options have been exhausted. Claims handling and dispute resolution. Question 26. Multiple choice question. Which of the following is a primary factor that determines the premiums of a health insurance policy? A. The insured's personal preferences. B. The insured's medical history and risk profile. C. The number of dependents claimed on the policy. D. The insured's occupation. Answer. B. The insured's medical history and risk profile. Explanation. Health insurance premiums are primarily influenced by the insured's medical history and risk profile. Insurers assess the likelihood of future claims based on factors like pre-existing conditions, age, lifestyle, and overall health. This helps determine how much the insurer will charge to cover the individual health insurance pricing and underwriting. Question 27. Multiple choice question. What is the primary difference between a claims-made policy and an occurrence policy in general liability insurance? A. Claims-made policies cover incidents that occur during the policy period regardless of when the claim is filed. B. Occurrence policies cover incidents that occur during the policy period even if the claim is filed after the policy ends. C. Claims-made policies do not cover any incidents that occur after the policy expires. D. Occurrence policies are only applicable to personal injury claims. Correct answer: B. Occurrence policies cover incidents that occur during the policy period even if the claim is filed after the policy ends. Explanation: the key distinction between a claims-made policy and an occurrence policy is when the incident happens versus when the claim is filed. In an occurrence policy, coverage is provided for incidents that occur during the policy period even if the claim is filed after the policy has expired. A claims-made policy only covers claims made during the policy period regardless of when the event occurred. Types of liability policies. Question 28. Scenario-based question. You are the insurance broker for a small business in Delaware. The business owner wants to buy insurance that will cover damages to his property and equipment, as well as protect him against lawsuits for accidents involving employees. What type of insurance should you recommend? A. Workers' compensation insurance. B. Property insurance and liability insurance. C. Health insurance and liability insurance. D. General liability insurance only. Answer: B. Property insurance and liability insurance. Explanation: for a small business, property insurance would cover damages to the physical property and equipment, while liability insurance would provide coverage for lawsuits resulting from accidents, including those involving employees. Workers' compensation insurance specifically covers employee injuries on the job but would not cover property or lawsuits. Business insurance coverage. Question 29. Multiple choice question. In Delaware, which of the following actions is required by an insurance company if they choose not to renew a policy? A. Notify the policyholder 30 days in advance of the non-renewal. B. Notify the policyholder at least 60 days before the renewal date. C. Notify the policyholder of the non-renewal decision only after the policy has expired. D. There is no required notice. A non-renewal can happen immediately. Answer: A. Notify the policyholder 30 days in advance of the non-renewal. Explanation: in Delaware, if an insurance company decides not to renew a policy, they are required to provide written notice to the policyholder at least 30 days before the renewal date. This allows the policyholder to seek alternative coverage before the policy expires. Delaware insurance regulations. Question 30. Multiple choice question. Which of the following is an example of actual cash value? See in a property insurance policy. A. The replacement cost of the property without depreciation. B. The market value of the property at the time of the loss. C. The property's original purchase price. D. The replacement cost of the property minus depreciation. Answer: D. The replacement cost of the property minus depreciation. Explanation: actual cash value (ACV) refers to the replacement cost of the property minus depreciation. This means that the insurer will pay for the cost to replace the damaged property with a similar item, but subtracting depreciation for the age and condition of the original item. This differs from replacement cost policies, which do not factor in depreciation, property insurance, and valuation.